Fine, thank you.
What time is there? Is 1 hour more? Here it's 15:20. There is 16:20.
Yes, we have 16:20.
Are you going to change the time in October, November, or it will be like this always?
As I remember, well, for several years, um, we don't do this already.
You need as it is.
Yes, we don't. I know.
Change.
Go on winter time. That's how it was named in Russian.
Mhm. So let's wait some more time. Meanwhile, do you have questions regarding what we have done last time? Yes? No?
No.
Everything is clear?
Yeah.
Okay. So now let's start the class. So I guess that you got the presentation, correct?
Yes.
Sure. People that are late. Okay. So you got the presentation, then you can see it. So by the way, you know that I have the microphone. So if you need, I can use it. Okay. So can you see my screen, or is not so? The definition is not so good.
We can see it. Yeah, but definition is not good.
But what is your speed connection? Because mine is very high. It's high. It's 200 megabit.
I also see it not in very good quality.
But what is your speed connection, Anton? Did you?
About 40 megabytes.
Megabit.
Megabits, yes.
I think that a solution to this problem would be if you could send the presentation.
I did it.
We cannot. Oh well, yeah. Then that's good. We cannot change the connection or the quality.
Yeah, I know. That's why I sent it last time. Can you see this presentation? You should have received it. Tanya?
Yes, I found it.
Okay. Good. Okay, good. So let's move forward. So we discussed this thing, and why we discussed this, Tanya? Do you remember? Why we said that the skew and the kurtosis was important? Tanya?
Yes, could you please repeat the question? My internet connection is not stable.
Okay, so I said why we discussed the kurtosis and the skewness.
We discussed it because we need to find kurtosis and skewness to define the risk of the investments we carry out. For example.
Yeah, because if you are,
and we understand, for example, the sharpness of the peaks and
yeah, the idea is the following. If we use a model like this, so this model that I showed you last time, that is based on the assumptions that the distribution is normal, then, as you said, could be that we are underestimating what could be the risk, because then we can have skew distribution in reality, and also some kurtosis, in this case, a negative kurtosis. And again, in this way, if we don't take into account this characteristic of the time series, then we underestimate the risk. And why the risk is important for options? Anton?
I remember we discussed it in last lesson.
Mm-hmm. Why the risk is important for options?
Maybe because options, the price of options is depends on its price of previous period. No.
No. Ivan? Ivan?
I haven't idea.
So, is my question clear? Ivan?
Question clear, but
Okay, you don't know the
I
answer.
haven't. Yeah.
Okay. Ekaterina?
The question is why it's important to take into account the risk in options?
Yeah, why the risk is important when we deal with options? Is the question clear or is not clear?
Yeah, but like it's there is some uncertainty that the price of a stock will of an increase or decrease? Or
No. Nick?
Because in case of options, this risk, this uncertainty determines the price of the contract. Because the more risky it is, the bigger compensation the short position requires.
Well, yes, there is a risk, and the risk is in the volatility actually for options. I ask the last one and then I explain it. Daria?
The same question, right?
Yes. So first, is the question clear or is not clear?
Well, from what I understand, the question is why do we need to take into account risk when pricing options?
Yeah, why the risk is very important when we talk about option, when we deal with options. Is this question clear?
Yes. Well, I think maybe someone has already said it, but risk is important because it influences the price of the option and whether it will be executed or not.
Okay. Okay, I will explain you this. I mentioned it, but let me say it again. When we deal with the derivatives in general, we have leverage. Do you know what is leverage? Do you remember it? Anton, say it, please.
The leverage is some extra assets that we have in debt, so it's not our property, but we use it in financial market to increase our profit.
Yeah, this is another thing. But if you remember, I tried to explain last time that if you have a company and then you buy something, for example, a factory, then in your balance sheet, you have in the asset this value, the value of the factory. Do you remember this example? Yes or no?
A bit. Maybe our leverage is not shown in balance sheet, no?
So if you buy a factory, this factory is in your balance sheet, in the asset. And then if you lend this money, if you take this money from a bank, then on the liabilities, you have your debt. Is this clear to everyone? So you buy a factory for 1 billion and you have a debt in your balance sheet for 1 billion. And this is fine. But then, if you instead consider derivatives, you have a leverage in the sense that with one option, maybe you buy 1,000 shares. That means that if the price of the option is 1, you have in the balance sheet 1. But in reality, you are exposed to the price movement of 1,000 securities. Is this clear or is not clear?
So the main idea was that we don't buy just like one derivative. We just buy several hundred or even 1,000
No, you buy
of them.
one derivative, but with one derivative, you are exposed not to one security, but you are exposed to the price, the change in price of 1,000 securities.
Okay,
Is this clear?
it is.
So if there is a change of, I don't know, 1 ruble in the price of the underlying, you know what is the underlying, we said it. You remember? Yes? So if there is a change of 1 ruble in the underlying, you may earn or you may lose 1,000 rubles. It's clear what I'm saying or not?
Can I ask a clarifying question?
Yes.
Do we use leverage by applying derivatives, or
Every time that we deal with derivatives, so future, options, swaptions, and so on, are all derivatives.
okay? Thank you.
So every time you have leverage, and then it depends on the contract. There are derivatives for which you have a leverage of 10, derivatives for which you have a leverage of 1,000,000 or whatever. So it's written in the contract. What is your leverage? It's clear to everyone, this.
Now it's clear.
So again, you spent 1 ruble for the derivative, but the risk is not 1 ruble. And then, regarding the factory, if the factory is destroyed, how much you lose?
And what's the leverage? 1 to
The
100?
factory. If the factory, we made an example just a couple of minutes before. We said we have a factory. If the factory is destroyed, how much you lose? You lose the value of your factory that is written in the balance sheet, not in book. So if the factory is worth 1 billion, you lose 1 billion. But with derivatives, it's not like this. You buy a derivative for 1 euro, 1 ruble, but the risk is not 1 ruble. Is clear to everyone this thing?
Yes, yes. And what's the lower bound? Is it 1 to 100? I mean, lower bound of leverage.
Sorry?
What is a lower bound of
There is
leverage?
no lower bound. It depends on the contract. So there is a contract that is for 10, and a contract that is for 100, contract that is for 1 million. It depends. It's defined in the contract, what is the leverage. Yes. And the vast majority of derivatives are not traded in regulated markets. So they are, if they are not traded in regulated markets, where are traded?
Over the counter markets.
Over the counter. So that's why there are customized contracts. They are not standard. You can find many kinds of contracts depending on the counterparty. Anton, Daria, Vladislav, is this clear?
Yes.
Yes, of course.
Okay, cool. So this is the first reason. And the second reason is that we will see later. But anyhow, when you sell an option, it could be that you have a potential infinitive loss. For this reason, I mentioned that there are margin calls. Those margin calls are needed in order to, every time, to make sure that you have enough money on your account and to pay for the imbalance. So when you make a loss, you have to pay. You have to pay because the money that you posted on your account is not enough. Is this clear? Okay.
But shouldn't it happen with some neglectable probability?
Of course not, because there are people that lost all their money. There are banks that have been bankrupt for that.
Okay.
One, let me see. Just a second. Can you see this link in the chat?
Yes, we can.
Okay, so this is just an organization. And also there is a book, there are some videos about this. So this is an example. So you can read as a business case. Okay. Okay, so we said there are two reasons for that. One, to measure correctly, properly the risk. One is the fact that we have a leverage, and the second is the fact that we may have infinity loss. So we already discussed these things. We said that the model, and we said that there are two parts, and the deterministic and stochastic. Then did lemma, and then we did this Monte Carlo valuation. You remember, no? We did Monte Carlo valuation. Okay, there is also something different, not only Monte Carlo, but we do have this Black-Scholes formula that is that comes from this this process, this stochastic process. So what is this formula? Then you start by defining the logarithm of what? Of S, and S is the stock price, and X is the price that the strike price, the price at which you agreed to sell or buy the security. In this case, as we have a call, we buy or we sell. Dimitri, we buy or we sell?
I think we will sell.
You sell. No, you are wrong. Ivan? Anton?
If we have positive difference.
Call. We have a call. When we have a call option, we buy or we sell. Yes, Otabek, we buy. So we have the option to buy, not for sure, because then depends whether the payoff is positive or not, no? But the idea is that we want to buy. So normally we check, is the price of the security bigger than X? If yes, then we exercise the option. Anton, it's clear this or not?
Yes.
We have the option to buy, I don't know, 1 barrel of oil at 50 rubles. And on the market, the price is at 70. What we do?
In the market, price is 70, and what you said before?
The exercise price is 50.
I think we should sell.
We sell. Otabek?
I think that we buy.
So please explain to your friend.
Because when we have a call option, there is a formula that is like maximum of S minus K and 0, and stock price is 70, and exercise price is 50, as far as I remember. And we have a positive difference.
So we on the market, this thing is worth 70, and we have the possibility to buy something that is worth 70 at 50. So that's why we buy, we exercise the option, because we pay less than the value on the market. Is this clear?
Yes.
Good. So we buy. And then, so this is the logarithm of this ratio. You see the slide, and you have it on your your computer. So this is the risk-free rate, and then this is 1/2 or 0.5 times the sigma squared. This is multiplied times time to expiration. So the time that for which the option is valid. And then we divide this by sigma and the square root of t. So this is the one. And what we don't know about this formula, what this expression, what is unknown? So we go to the market and we ask, what we don't know about this? What is known and what is unknown?
We want to know the stock price.
So
the
stock
future.
price, just a second, Nick. The stock price. Can we see the value of the stock price on the market?
We see it now, but in the
No,
formula.
no. We talk about now. Yes. So that is known. This is a known value. So let's go ahead. Yes. What a big is that? So what else? Nick, let's go ahead. What is the second value?
Strike price.
And this is already in the contract because we agree given strike price. This is something that is known, no? Is a known value.
Yes.
So then let's move forward. Risk-free rate. Is the risk-free rate known?
Yes.
Good. And then we have 1/2. That is a number, is known. And then what Otabek said, what is unknown? The time to expiration is something known or not?
Known. It should be stated in the contract as well.
Correct, correct. So the only thing that we miss, that we don't know, is the volatility. And the volatility, we mentioned before risk. We said, what is the risk of an option? Well, and the risk is what we said before. So is the leverage, is the fact that we may have infinitive loss. But then the option, the derivative, is something that is linked, that takes value from something else. And what is this something else? Something else is the underlying. It's clear? Derivative, because the value of the security derivates, it comes from something else. And this something else is S, is the underlying. Ekaterina, it's clear what I mean?
Kind of.
Yes or no?
Mostly no.
No. So, Ekaterina, what is not clear?
Maybe while Katerina thinks, I have a question about standard deviation. So we can calculate it, right?
No, just a second. So,
okay.
We have the derivative, and we said the derivative is something that takes the value from something else. It is not a standalone security. It is a security that derivates from something else. That something else is the underlying. Is this clear?
Yes.
Okay. And this standard deviation is not the standard deviation of the derivative, but is the standard deviation of the underlying. Because we said when we have a derivative, then we are exposed to the change, the price change of the underlying. Is this clear? we are exposed to the change of the underlying. So that standard deviation refers to the risk of the underlying. So you said, Nick,
Yes, I asked about standard deviation.
yes, and then you said, well, we can compute it. It's not a problem, no?
Yes, I did.
Well, but in reality, if you compute it, what do you use?
We use the values of stock price, I guess.
Yes, yes, but which kind of values you use? You use the price that were available in the past.
Yes.
And this is the problem, that the derivative doesn't expire in the past. It will expire in the future.
Yes, but shouldn't these formulas solve this problem? No? So,
No, because we said that the standard deviation is unknown.
okay. Because we
So,
don't know its future values, right?
correct, because the price of a derivative depends on the future change of S. Is this clear? Not
Yes,
the
it is.
present value of S, is the future change of S. And more precisely, how the future change of S influence the loss that you may have. Is this clear?
It is.
So if you compute the standard deviation of the past values of the underlying, you will find a value that is meaningless. So what the traders do is to estimate this sigma.
They try to make a prediction about future values of S.
Exactly. Exactly. That is the thing. So traders try to estimate what is the future value of the future risk of the security and underlying, and then the derivative. And then, because of this, there will be different values on the market. I mean, different values of the option. And then, because of different values of the option, then you can assess how much is this sigma. It's clear what I mean? Anton, is clear that?
Yeah.
Sure. Anton, is this sure? It's clear?
Yes.
Okay. So, what we don't know, we said, is this sigma, okay? But there are ways to estimate this sigma. And then I published several papers on this, how to do it. And then this is D1. And D1 is the argument of this N. What is N? N is the normal distribution. Do you remember when we did the calculations on the spreadsheet? We used a random value, no? and we enter that random value in the normal distribution. So this D1 is the random value that we used. And this D2 is the value of before minus sigma square root of t. And then when we have a diffusion process, the diffusion process is always like this. Then it follows this behavior. So you have sigma times the square root of t. So here, this D1 is the argument of this. And this D2 is the argument of this normal distribution. So more or less, you can think, okay, and this one, do you know this one? What is the meaning of x times e to the power of the risk-free times the time to maturity, the expiration?
It's the discount rate, isn't it?
Correct. You discount that value because that value is not something that you will get now, but you will get in the future. So let's go back to this formula. We have S, then normal distribution minus the present value of x times this thing. And then you can think about this formula like a weighted probability of where this S will move in the future. Because this normal is the inverse normal that we have seen. So this is a kind of weighted probability of what will happen in the future to your underlying. You may think about this formula in this way. And why we need to discount x? Well, we need to discount x because we said that the payoff is s minus x. In this case, we express the same idea in terms of probability. So n d1 and n d2 are there to express this changing weights. Okay. And of course, because when you increase the probability from one side, you should decrease the probability on the other side. D1 and D2 are linked together. Okay. Is clear to everyone this thing?
So again, we can think of this formula as the weighted sum of the probability of what? So
you have the probability that S will go up or the probability that S will go down.
And as go up, it's to
And then
D1.
You have a normal distribution. You have a normal distribution that gives you the weight, how much the likelihood that this will go, the S will go up or down. Okay.
Okay.
So if you move to the left or you move to the right, because you remember that D1 is the argument of the normal distribution. That means that you move to the left or to the right. Yes?
Yes.
And then moving on to the left or the right is a matter of risk. Because the only thing that you don't know there in that formula, and this D1 is the risk, is sigma. All the rest is agreed and known.
Okay.
So you move to the right, but you move to the left regarding this normal distribution, depending on this D1. And again, the only thing that matters is this volatility.
Okay, thank you.
And volatility is something that you don't know, you have to estimate. And you cannot compute it, because we said that we don't care about the past. We would like to make a forecast. We want to know what is going to happen in the future, not what happened yesterday. Dania, do you have questions?
No, I don't.
Is this clear what I said?
Yes.
Okay, so let's move forward. Then let's make an example. You have a calculator. Can you check these figures?
Are all the brackets in place? I've got 0.42 or something.
35, it's here.
Yeah,
We
I
are talking
see.
about B1.
Yes.
Yeah, this should be correct. Let me take this one, okay, the formula.
Yes, I've checked. It's correct.
Okay, good. So now we know that this thing is correct. Thanks. And then from D1 you compute D2, and then you enter this 0.45 into the normal distribution we said, and then you will get this value. this value, you can do it in Excel like we did during our exercise, okay? And then you get D2, and from D2, you enter D2 in the normal distribution, you get this value, and then at the end you get, this is the price of the call.
And I guess the most difficult part in this exercise was preliminary calculation of sigma, right?
That is something that you don't know, and if you are interested in this thing, I can send you a paper about that, because I published several things about how to compute this. Because if you work on the market, this is the first thing that you have to do to estimate the sigma. Okay.
Okay.
And it's not the standard deviation that you can do. It's something different. And here you have an example with dividends. At the end of the day, it doesn't change so much, because what you have to do is just to discount this cash flow. But it doesn't change so much. It's not a big deal. Okay, so you do this with yourself. And then there are this is kind of question answer, and you should be able to guess to answer, and then this is already solved. This is regarding the call. And then you have another one that is for the put option. So let's see together this one for the call. So when the security price goes up, what happens to the call? Ivan? Dimitri?
Why security price increases the value?
Yeah.
Because it's in the numerator of the logarithm. So
yes.
If the security price is bigger, then the value is bigger too.
Yeah, because also the payout, we said, is S minus X. So if S is a bigger number, then also the value of the option will be bigger, no? Yes, Dimitri?
Yeah.
Good. So now, still, what happens when the exercise price increase?
Call value decreases.
Why?
Well, formally, because it's the denominator of the logarithm, and due to the essence of the question, because you can get less value when the excess price is higher.
Yes.
So your markup will be less. Yes.
Nick, can you see the chat?
Yes, I can.
Okay, so at the end, that is the payoff, no? So if you increase X, the value will be lower, the value of the option. This is clear, no? It's easy.
Yes, it is.
Good. So now, time to expiration. Daria?
I think that if time to expiration increases, the call option value increases because
Because?
it enters in the formula in a nonlinear way. So
Yeah,
I
this
think,
is right. This is right. But
but like based on common sense, I think if the option can provide a kind of certainty or over a longer period, it can mitigate risk somewhat over a longer period, and that's why it's more valuable.
okay, so any formula should have should represent something that is related to our life. No, in this case, we want to represent with this formula the value of a call option. So it's not the common sense, but a beautiful formula that is wrong in the sense that doesn't represent the reality is worthless. No. So what is the point? That the call gives us, we said, the option to buy something in the future. Which price? At the agreed price that we said that is X. Can you hear me?
Yes.
Let's say that the price of the security now is 30 and X is 50. What we are going to do? We exercise the call or not?
The price is lower, so we would buy that price instead of exercising the call.
So we will exercise. You will exercise the call or not?
No.
No. But if the option expires not now, but it expires in a month, can this value S change? Because X is the strike price is fixed, correct?
Yes.
The strike price is fixed, will not change. What can change?
The stock price.
Okay. If we said that now the stock price is 30, but in a month time, is this possible that the S will be higher than X?
Yeah, that's possible.
Okay, and if I give you instead than a month, I give you 1 year time, is this more likely?
Well, maybe.
We know that now is 30, but in the future, things may change. Right? Yes, Daria?
Yes. Yes.
And the longer is the time, the bigger can be the change. It's clear what I mean.
Yes, it's clear.
Because if the option will expire tomorrow, then it would be difficult that we move from 30 to, I don't know, 60. No? But if the option doesn't expire tomorrow, if the option will expire in a month, in 6 months, in a year, it's possible then S will be much different from now. It's clear or not?
Yes. I think that's what I said.
Correct. So the more the time you give, the more the time, the more likelihood is that this S will be much bigger than X.
Yes.
Okay, so that is the reason why there is an increase. And then there is the free rate. Ekaterina?
Yes, as we can see, it increases. So as risk-free rate increases, the value of call, the call value increases too. Like if the risk-free rate we don't have a risk and it's a rate of our...
Yeah, Katerina, what you do is that you discount X. The higher is the free rate, risk-free rate, no? And the higher is the discount of X.
Like from formula you can see that.
Yes, so when you discount X, you reduce X. It's clear what I mean? When you discount X, you reduce it, you make it smaller.
Yes.
And if X is smaller, then this difference between S and X is bigger.
Yeah, so the value is bigger too.
Okay.
But actually, it's not that plain, because we have the same risk-free rate in D1, and it doesn't go into the formula linearly.
No, you don't see that. You see from the formula that they put in the chart.
Okay.
Can you see the formula in the chart?
Yes, of course.
So you can see from there. That is very easy, because if you have a look at the Blanket-Scholes formula, it's more difficult to understand the effect. But from this formula, it's very easy, no?
Okay, yes, it's true.
And then here we need to talk about the volatility. And then this is similar to what we said with Daria. The fact that the security, the underlying, may increase depends on the two variables. One variable is time, and another variable is volatility, because the more volatile the security, the more likelihood is that there will be a bigger change in the price. What we said before regarding time, the more the time, and the more the chance that the security will move in the future, no? And now the same thing, the more the volatility and the more the chance that the security will change price. And if we change, the security changes price, what is the thing? That we always look at the payoff, that is the formula that you have in the chart. Yes. When you see that, then at the end, well, if the value of the security goes down, you cannot do anything, you have zero. But if the value of the security goes up, then it's good for you, no? Because you make money. So Daria, is the same thing that you said before. Okay. This is the same thing that you said before, but this is applied to volatility. Before we discussed the time, now we discuss volatility. It's the same thing. The higher the time, the higher the value of the option, the higher the volatility, the higher the value of the option. Why? Because there will be a bigger movement of S. Okay? And then the dividend. Well, then you decrease the value of the security because you have to discount the payoff. And this is clear. So when you have a payoff, to discount, the higher the payoff, and then the higher the discount. Yes? Yeah? Okay, so I leave to you this thing to do that, okay? This is for the put. Okay? I guess that we finished the class today, correct? Or we have additional class?
No, we don't, but we still have like 13 minutes, I guess.
We have, very good. So, very good. So, let's go ahead. You do this, we said. And then I will explain you this thing, the put call spot parity. You have the slide with you, okay? Then let's talk about a share, stock, S, what we called it before S. Now we call it in another way. We call in this way. We call W by Z, okay? Is a common stock. And the price is this thing, is S. So the security can be, I don't know, Gazprom, whatever, no? And then we are long. What means that we are long? That we own the security. So we buy a security that is Gazprom security, okay? And then we say that the price of this security is S. Then we are long in a put option. That what is the meaning of long is that we have the option to sell. The call option is the option to buy. The put option is the option to sell. It's clear?
Yes, it is.
Good. Now, and when we have an option, we have to express in the contract the exercise price and the expiration. Yes? Two things of the contract. And then given the price, the exercise price, given the expiration, given also the value and the underlying, we said that the underlying, the value of the underlying is S. Yes? Then we can negotiate the value of the put. And then we are short with a call option. Short call option, it means that we sold to someone else the right to exercise the option, the call. And in exchange, we got a premium. And what is the premium, the price of this call? Well, the price of the call is C. And we said before how we compute it. No, we made these calculations. No, remember, in this case, for example, C is equal to 649.
Yes, but our formula in chat, well, it doesn't.
No, you have to check now.
Yeah, okay.
You have to use this one.
Yes, I see.
Okay. The Black-Scholes formula. Yes?
Yes.
Good. And then let me go ahead. Well, then we have this thing we said. We have this portfolio, and how much is our investment? We buy as the security Gazprom at the price S. And then we paid P for the security to buy a put security, okay? And then we are selling this call. So in our balance sheet, we have S, P, and because we are short of a call, we have minus C. Is this clear? Our portfolio is made of a security S that is worth S. The price of this security is S. The Gazprom security is worth S. Is made of a put option that is worth P, and then we have a short call that is minus C. It's clear that?
I have a question. Why do we have P, so the price of put, with positive sign, not with negative?
Yeah, because this is the asset that we have. This is our balance sheet. This is our net investment. Is how much is worth our balance sheet.
So these are not our costs, yes? It's,
no, this is not the cost.
Value.
Not the expenses, Anton.
Yeah.
Not the expenses, but is how much is worth your portfolio.
Okay, it's clear.
So what we do at the expiration? At the expiration, there are two options, two possibilities. One possibility is that S is bigger than X, and the other possibility is the opposite. You agree with me? Okay, so what happens? Let's have a look at this case, so this column. Well, if we are invested in Gazprom and the value is whatever is 10 rubles, 100 rubles, whatever. So the value of Gazprom is the value of Gazprom, yes? But then, how much is worth the put? The put is worth 0 because S is bigger than X. Do you agree? The put, in this case, cannot be exercised. Yes or no? We cannot exercise the put because S is bigger than X. If you remember, this is a positive condition for the call, but this situation is not good if we have a put. It's the opposite.
So we're not gonna sell our stock for the price below the market one, right?
Correct. Correct. So the value of the put is 0. And then how much is the value of the call? Well, the value of the call is, we said that we are shorting the call. It means that someone else, that our counterparty, will exercise the call. Why will exercise the call? Well, because he can buy something at at X that is worth more than X. The value of X is of the security is bigger than X. It's clear? So
someone is gonna buy our share for the price lower than the market, and we're gonna lose this margin.
Exactly. Here we are going to lose because we are shorting the call. Okay, we have S, and we are minus S minus X. So at the end, how much is worth our portfolio? Well, our portfolio is worth X. No? If you do the net between this and this, you will get S. Do you agree?
Yes.
Okay, same thing on the other side. When S is smaller than X, what happens? So we still have Gazprom. But in this case, we can exercise the put because we said that S is smaller than exercise price. So we can exercise the put. Daria, can you follow me?
Yes.
Good. And then what we do, and of course the call is 0 because we are in the opposite situation. So again, the net investment. So Anton, regarding what you said before, the net investment, so the balance sheet is X again. Oh, if you have a look at your balance sheet, how much you have in your portfolio? Well, your portfolio is worth X without considering the cost. No, we don't consider cost. We are just checking how much is worth your portfolio. Yes?
Yes.
Good. So what happens then? Because of this, whatever happens, we have the same result. And what is the security? That whatever happens is always stable, gives you the same value. Is a security that has no risk. Whatever happens in the market, you will get always X. It's clear? And what is the security that is without risk? Well, the risk-free security. It's clear?
What's the last idea again?
Okay. Let me go back. Here, there are two options, we said, two possible scenarios.
Yes, and in both of them, we get X as our expected. Yes.
And that is, if we have two possible scenarios and we always get X, that means that there is no risk.
Yes.
It's clear. So whatever happens, we always get X. So this portfolio is a risk-free portfolio. There is no risk. We always, for sure, will get X. So if this is true, that we have a risk-free portfolio, then we should have a risk-free security. And what is the risk-free security? Well, the risk-free security, for example, can be a T-bill, a treasury bill, a security that is, again, that we define as risk-free. So whatever happens, we will get it. Okay? Anton, Ekaterina, Daria? Okay, so then we are in a condition in which there is this equivalence between what? The equivalence between a T-bill and then this X. So at the end, this is what we said before, Anton, you remember? We said S, you remember, S is your security, P is the put value. Minus C, what is it?
Value of call.
Yes, because this is our balance sheet, remember. Not the money that we spend, but it's our balance sheet, our asset. So we shorted, if you remember, in our portfolio, we shorted the call, so it is minus C. And on the other side, we have a security that must be risk-free. Okay, so that means, again, that we can discount. Of course, we have to discount it because it's not for today, but is in the future. So we will get this X not today, but the expiration. So at the end, long stock that we said S, no, this thing. Let me copy it. Long stock S, long put P, short call minus C, it's equal to the long T bill. And why we said that? Because this kind of portfolio is a portfolio for which we have the equivalence. And here you can find an example, and you can do it by yourself, this thing. You can do the calculations. Yes, they are not difficult. Daria, is clear? You have questions? Anton?
It's clear.
Ekaterina?
Yeah, it's clear.
So then we can end the class now, correct?
Yes,
So,
correct.
okay, so let's meet the 6th.
Yes, okay. And we should send you our presentations and essays.
Yes, please. I
before.
got one so far.
Okay.
Can we send them just before the class?
Well, not just before. Try to do it a little bit earlier. So, I don't know, 1 hour before, 2 hours before, but not just before.
Okay.
Okay?
Okay, goodbye.
Bye.
Thank you. Goodbye.